to you.
Hello. If you can hear me.
Yes, we can
Hi,
hear
Mike.
you.
Yeah,
But you
I
can't
can hear
understand
you,
you.
but not see you.
Very funny.
I said I can hear you but not understand you because I forgot to say it to you when you asked me.
All right. Don't you guys start speaking German now?
Hey, Mike, do you have a video or you're going to be off cam today?
No, it's on pause here.
We can see you.
There,
Don't
we
know
can
why
see
it's
you now.
buffering.
I
You
see.
can. Okay, I can't see you, but okay.
We are now got visuals on Mike and Christoph, which is an exceptional.
We're live streaming now.
Yeah, okay, well, let me get my visuals. Mike's gone off again.
And we are over the time.
Okay. Mike Muller, are you ready? Cool. Everybody good? 5, 4, 3, 2, 1. Recording begins. 5, 4, 3, 2, 1. Good afternoon or good morning even, and welcome to the Daily Energy Markets Podcast. It is Sunday, April the 7th. It is the wonderful first Sunday of the month. And this, we're going to say, the first Sunday of the quarter, where we haven't had a chance to chat to the guys for a while. And so we'll take a quarter in review, not only a month in review, and maybe do the same looking forward. We've got a good time to have a conversation because, of course, Brent crude oil has firmly locked in above $90 a barrel. Been on a bit of a tear since mid-March. And we might look at the reasons for that. Mike Muller, head of Vitol Asia. Mike, just reflecting on the first quarter, your sort of surprises. When did we turn a corner? Have we broken out into a new sort of trading range? Let's say your thoughts on reflection of Q1.
Yes, I mean, I think what we witnessed in the last few weeks is a realization by financial participants in our markets that oil was something they wanted to be longer than they were. We've spent much of the last 6-12 months having most sort of macro funds and non-physical players in our market sitting on the sidelines, deciding to be risk off with a couple of entries and exits around geopolitical situations. But there was a big macro inflow, as we refer to it, in the last 3 weeks. Now, on the historical scale, it's still nothing. We still have relatively low participation in energy markets, but there's a realization that energy commodities correlate extremely well with inflation. And if there's renewed concern of inflation, then this is a hedge people seem to want. By the same token, of course, you get people who've been trading the range. They've been basically buying mid 70s, low 70s, high 70s, and they've been selling 80s, high 80s. And whenever the markets break into a new trading range, and that psychological $90 barrel is the number, I guess, then a bunch of people stop out. So you'll have a little bit of that as well, where people who were short decided that they needed to trim their shorts or indeed cover. So the backdrop to that, of course, was then that OPEC Plus decided to do what was largely expected, I guess, and continue to roll over their current state of affairs. And as such, we have a market that is not necessarily tight in the prompt, but given most people's projections for later in the year, most people, most consultants, most experts, most advisors are calling for stock draws later in the year. And that's giving a firm underpinning to the fundamental picture as well. All the while, of course, we must remind ourselves that OPEC and Saudi in particular have the option to change that picture by gradually letting volumes back into the market from their spare capacity, should markets get even stronger and that not be to their liking.
Christoph Ruhl, a senior research fellow at the Center for Global Energy Studies in Columbia University. Christoph, is this reflecting on Q1 and this sort of breakout, if you like, from a Brent crude oil? Is this sort of good economic news driven? It's demand driven. It's China, America looking better, or is it, oh my God, the world's going to end. There's a war coming. There's more wars coming. OPEC Plus has cut so much that supply is tight. I mean, I'm trying to understand, reflecting on Q1, is this a good story or a bad story?
Good morning. I think it is largely a geopolitical bad story. And I'll come back to that. But when you ask sort of about how it links in with the macro environment, then there's a few sort of basic points to make. Number one, compared to what we discussed here earlier in the quarter, it looks as if in the case of China, everything is as predicted. They have found a bottom. They will not go back to 8% growth, but it's reasonable to expect 5+. They have enough firepower to extinguish the little fires they have. They have a huge, big conflict brewing with the EU and the US still because they don't move as they should into a service economy with decentralization. They continue to try to find industrial activities to rescue them, mostly in the EV battery and generally green technology space, where they are just too cheap for the Americans and the Europeans to take that on their chin. So China, in terms of your question, good story, continues a good, relatively good story. The US is a bit different. That has changed here with the realization setting in that inflation is not dead yet. Here again, in our discussions, we have often emphasized that given the loose fiscal policy of the Biden administration and given the huge debt levels and and expected fiscal deficits in the US, one should not think that inflation is dead. So it will come on and will probably establish a range for itself at 3+% or something. And at some point, the Fed will have to make a decision to really not crash the economy, but risk to run a recession and bring inflation down, or to sort of lean back and be a bit more accommodative about it. Now, what comes on top of that is the first big link to politics, and that's the upcoming elections. You will see, the Trump people leaning onto the Fed to do interest rate cuts now, and you see the Biden people leaning on them to do interest cuts now. The Trump people say, wait a bit, in order for the economy to get worse. So traditionally, the Fed tries to stay a little away from this immediate policy making in the face of an election. So that's going to be a very tricky world if inflation doesn't come down for them to hold on. They will be accused of electioneering. And so the closer we get to November, the more messy
on that point,
gets.
Christoph, why would they make a move? That's I suppose my big sort of quandary, in the sense that if inflation is still well above target and you got full employment, what would trigger them to take preemptive action on what?
For them, for the same reason why they were late in hiking rates in the first place, the eternal hope that you can get away without bringing down the economy. So the thought, that the economy has done exceedingly well, but the numbers are shaky, revised all the time, particularly the employment numbers always come in too low first, and then the employment numbers come in too high and are then revised. And the hope that you can do a little bit of a rate decrease and give an economic signal while inflation expectations remain anchored is a very tempting hope, because the alternative would be to keep interest rates up, inflation expectations change, and the economy has to go perform worse, and growth will come down and unemployment will go up, and they don't want that. So that would be the rationale. But what this leads to is not only the Democrats and Republicans fighting and the Fed sort of sitting uncomfortably in the middle. We should never, I think, in the current, and this is the link now not to local politics, but to geopolitics, forget that Russia and Saudi Arabia also have it in their hands, not only, as Mike said, to relax the market, but to bring US gasoline prices up before the election. And in this particular, I'm not a conspiracy theorist at all, as you probably know, but in this particular instance, I think the desire, at least on Russia's part, to see Trump win the election must be an overwhelming incentive. And then let me make the last point. Back to the oil markets here. I think the main reason for this is, there's all the reasons Mike said, and they're all correct, but one of the main reasons is also that gradually it sinks in that when people were afraid of last summer, the Ukraine having a successful offensive and all that, and if Russia is cornered in the play the oil market card and just curtail exports, bring prices up, create a recession, that this equally well applies to Ukraine, given its capacity to destroy refineries. That translates into a similar capacity to destroy export terminals and all of that. So if they want to prevent, influence the US election, prevent certain funding not to arrive, and so they could put pressure on their friends that way. And this is becoming an increasingly likely picture.
Well, we do seem to be increasingly sucked into the obviously US election vortex. Mike, just looking at, again, the sort of more sort of focus in on the breakout moment, mid-March, if you like, when we sort of seem to come out of the tight high 70, low 80 and move now into, above 90, but progressively in that direction over a few weeks. It seemed a number of things happened at the same time. Again, as mentioned, inflation concerns came back in and the likelihood of rate cuts diminished. We also had the OPEC Plus announce the rollover of their cuts into the second quarter, and the geopolitical heat turned up a bit. I mean, as you reflect on those different influences, do you think any one stands above the other as a driver, and then where this could go? But in terms of the breakout, does any one of those stand more out for you as the trigger for the breakout?
No, I think the fundamental physical changes in the oil markets have taken a sort of second-tier backseat to the money flows. I think financial markets have convinced themselves this one is a buy. Yes, you've had some disappointment or concern. The blockages in the Red Sea, thanks to the Houthi attacks, resulted in an almighty great big stock build of product, in particular on the water, and it was perceived that would weigh on markets in some ways. And whilst physical markets at the front end aren't exactly tight, they're perhaps less awash than people expected. People keep edging up the demand predictions year on year for 2024. Places like India are growing at rates that were faster than expected. As Christoph said, China is throwing their policy machine at growth as well, so reassuring people there also. The industrial manufacturing indices around the planet, but China in particular, have now been positive. The key index there has been above the critical 50 mark for I think 4 or 5 months running now. And as such, people are looking for problems on the supply side. And whilst there have been no major stories, we've had Sudan out, of course, but that's not a huge one. That's several cargoes a month rather than a huge program. But we have no Kurdish oil back yet in measures. That's failed to come through Turkey so far. No resolution there. And as Christoph mentioned, the attacks on the Russian refineries have taken away some of that product supply and replaced it with crude supply up to a limit where you start asking yourself, is Russia at crude export maximum through the Baltic ports? So whilst we see these spectacular footages of drones hitting refining installations and big flashes of explosions, the capacity for the refining business to repair its damaged assets it always amazes me. But at one point, I think it does look as if we had the best part of 1 million barrels a day of refining capacity out in China because of those multiple hits. That last time I came on this program, I said I was very surprised by the ability of Ukrainians to strike that deep into Russian territory. But yes, air defenses haven't been doing their thing. So the culmination of everything there has just given people the reassurance that it's a tighter picture. But the biggest view, I guess, is the second half of the year, as I mentioned before. We're projecting refining demand in terms of the need for the world to run its refining system to be a lot higher than in 2023. For the second half of this year, maybe 2 million barrels a day more. And global demand growth is projected by most to be 1.7, 1.8, even a bit more than that, million barrels per day higher than last year. So we're not in any way petering out towards peak oil here. We're at one of the fastest year-on-year growth rates we've ever seen in the last 20 years of history.
Christoph, looking forward into the second quarter now, and this sort of disrupted what seemed like a fairly straight, very predictable monetary policy strategy globally. Everybody, all the major central banks were kind of lining up to move in synchronized swimming approach. Now we might look like having some divergence. Europe could move without America, etc. Your thoughts looking forward on the global monetary policy, different regions, different strategies, and what impact that could have?
I think this normal discussion, whether we have 6 cuts in the next 7 months or 5 cuts in the next 4 months, and this up and down, this reading the tea leaves. This is like, if the oil price goes to 89 or 87, whether that's worth discussing. Usually it's not. But sometimes in economics, as in oil markets, there are these kind of turning points. And I do think we are now approaching at least the possibility of 2, and so market concerns are much more justified and therefore likely to run much deeper than before. That is the possibility that inflation in the US, especially with these Biden reforms and the election coming up, settles in, and the Fed will not get it below whatever it is now, 2.7 or 2. And that means that they have to face a very very hard choice, which might have consequences either way. Either inflation settling in a higher level, maybe Trump winning, leave it where it is, or the economy sort of going off its stellar growth path, which it had. One of the implications is that Europe, because the economy is sort of slower and because the squeeze from China is more direct in their industries, and because there's much less of a unified policy, no unified fiscal policy, might now be in a position where they can lower interest rates first. And that is a world in which then these oil market repercussions come in. When I look at your question about the mix Mike described, and you asked for the layers for the most important ones, I do think that the Ukrainian capacity of taking out global refining capacity could become a game changer in that sense as well, a slight one at least, because refining margins might go through the roof, and that will affect gasoline prices, and that will affect inflation rates directly and indirectly. And it looks not only as if there is the possibility that Ukraine could do that in case the wrong person from their side wins the American election. It also looks, if I believe my Russian friends, as if Russia will have huge difficulties repairing some of this capacity, because this is largely Western kit. And when you destroy these things, this is big stuff, as Mike acknowledges, where the sanctions are still pretty effective and not getting that replaced in the next week or so. So that's going to be a potential problem. And there are so many of them, they're very hard to defend. So that is a weak angle the Ukrainians have discovered. They would certainly use it shortly before after the election if Trump wins, but they might even continue the level of tensions up. That will continue product prices up. That will exacerbate the problem with the Fed. So that is a situation now where the oil markets feed into the economics more than the economics into the oil markets.
Mike, looking forward, obviously, as mentioned, OPEC Plus rolled its cuts, its 2024 cuts and all cuts. Obviously, the main bulk of them are rolled right to the end of the year, but the 2.2 is till the end of the second quarter. Your thoughts now, and given the outlook and the sort of growing positive economic frame that the OPEC Plus group could look to start unwinding cuts in the second half. They do have a big meeting in June. How serious do you think they will consider that option?
Well, they convened a bunch of analysts and consultants in Vienna 3 weeks ago or 2 weeks ago, and their preoccupation there, from what I'm told, seems to have been financial flows in and out of money markets. They observe $1 per barrel backward Brent spreads, and everyone likes that because investors go long the front month and they roll $1 into their pocket every month. It's called the positive roll yield. That's a state of affairs that is a nice position for OPEC, right? It gives a certain degree of comfort that financial players will be in that space, and more will flow in and be attracted to a roll yield that, if you do get $12 per barrel on $90, you can do the maths. That's 13-point-something% return per year. Extremely attractive, right? So I think that's what's preoccupying people for the most part. There is, I don't think it is baked into most people's fundamental projections that OPEC Plus and Saudi in particular will continue leaving oil off the market for the balance of the year. I think there is a view that there'll be some pragmatism if $90 becomes $100 Brent, and there'll be a bit more oil released into the market. That seems to be in people's minds, at least from what I've been asking traders around me in my company. But
if you take the flip side of that, Mike, and you have a deficit in supply, and of course you draw down on inventory. Inventories are already low in relative terms. It all, I suppose the further drawdown of inventories from a market management point of view. I mean, OPEC Plus has done its job here. Doesn't really need more drawdown, does it? Your thoughts on that? The continuous supply deficit will continue to draw down already low levels of stock.
I'll keep my answer, but Christoph, you wanted to interject there?
Yeah, sorry.
No, but if you're done.
Yeah. I'll answer in a second.
I think that's where I part company with Mike a little bit. At least the numbers I look at, there's no sudden jump up in financial flows. I don't think this is driven by financial markets, number one. And number two, I think that if OPEC's, what we have to do when we talk about the resilience of the system to all kinds of disturbances and shocks, that people look at spare capacity. Right now, spare capacity is high. but they looked only at half of the coin this way, because you also have to look at inventories. And there, Mike is right, inventories have been drawn down globally, so that the amount of flexibility in the system is now less than it was before. And when I look at this going forward, the most important consideration is that oil prices are not really high. You know, when you make the inflation adjustment and when you adjust for the amount for the efficiency improvements which we have, which is exactly what we do for labor costs and all other kind of inflationary indicators, then oil prices today are sort of in a very moderate range. You know, and if I would be OPEC, I would tell in financial markets what they want to hear, which is what Mike has referred to. But I also would think that if it's 100 or 110, the global economy will be quite capable of swallowing that. And that's without the temptation of
Maybe if it
meddling with
wasn't
other
an
people's
election
elections.
year, that would be more
No, but
palatable.
their incentive to meddle in the elections would be to meddle on the side of high prices, no?
Yeah, that might be a bit too overt. Mike, picking up on that question?
Well, there's inventories and there's inventories. So I mentioned a few minutes ago that on the water inventories for refined products are pretty high, and they haven't really come off all that hard. And that's largely a function of rerouting of cargoes. We already have a structural rerouting because of Russian flows and sanctioned barrels subject to price cap needing to go to Asia when they'd normally find homes in Europe and so forth. So that's just taking another level up. But that's not the whole picture, of course. There are areas where inventories have been coming down. I mean, Chinese onshore inventories, to the extent that they're visible to us, are still healthy. But it's not the case everywhere. You wouldn't have $1 per barrel crude Brent spreads in backwardation if you had ample supply of oil at the very front of the market, right?
Yeah, I said they're coming down, and the spread used to be higher.
Let's just throw in the survey question, which of course the survey question, which is touching on this point. OPEC Plus will only consider unwinding cuts if Brent moves above 100. That 90s isn't the trigger; it would be above 100. Some thoughts on that, Christoph? Looking forward in the immediate period, we do have this very uncertain moment of geopolitical tensions risen between Israel and Iran, the possibility of an Iranian retaliation to the strike in Syria. So that sort of there is hovering. Everybody's on high alert in the region. You also have the possibility of the Venezuelan sanctions that have been for 6 months suspended. They're up for review mid-April. Your thoughts on some of these immediate threats and how they could impact markets?
I mean, it's all very clear and very uncertain at the same time. No? Biden has his work cut out for him. Take the example of the Venezuelan sanctions. You know, whichever way he goes, he will get political flack and little impact on what he must be concerned about, which is the domestic fuel prices. What I think where the real danger, of course, sits is in the latent conflict between Iran and the US. You know, to what an extent is the US now moving away from Israel, and to what an extent does that translate into, you know, making more of the kind of deals which they seem to have made with Iran last time, when Iran took retaliatory action by bombing an empty building and killing some Iraqis, but no Israelis and no Americans. So, and I think that also in Israel, and I'm not a political scientist, but I think that for Netanyahu, the incentives must all be to ratchet up the conflict. You know? And it seems to be almost flip-sided now, with Iran still not willing to go all in because they know they have no chance. So that situation in the Middle East between Israel, Iran, and the US is the most uncomfortable one. And the rest follows from that. And it's also the most volatile one. And none of us, I think, has any particular insight what Iran and Israel governments discuss in closed chambers.
Mike, on that point, did Venezuela's 6 months of openness move the dial at all? Has it changed flows? Has it done anything of note? And so if it was to go away again, it wouldn't be that big a deal. Your thoughts on that?
Not materially. What changes is the parties that handle the oil. Markets have shown us through the period of sanctions that those exports will flow. What's not happening, of course, is investment. But should General License 44 lapse in, what is it, less than 10 days from now, then Venezuela will likely revert to exporting its crudes via channels that will take them to markets that will flaunt the sanctions. But there is a view that this candidate that's been put forward for the opposition in Caracas might just provide Washington with the pretext not to allow GL-44 to lapse. But I think it requires an active decision of renewal. So we still wait to see. And of course, the entire system and the banks in particular are going to be very, very hesitant to support exports running close to that April 16th deadline. So it's going to be one to watch.
On the other side of that sort of, who flips and the nefarious sort of dark fleet, as it's called, on the Russian trade, it seems the American threats and sanctions have scared a lot of shippers out of that market. Has that changed the fundamentals of that flow in any way? Has it created impact for other areas of the market?
Short answer, Sean, not really. Obviously, it's very hard to see all of it. But there has been, in the side of the world where I'm sitting here, there has been a steady state, I guess, and a gradual acceptance that certain behaviors that are required in order to make Russian oil look less Russian, in other words, for it to be blended or processed or staged and then reloaded somewhere, those people happy to take these Russian products rather than crude, because crude is rather simple. It's China, India, in the Eastern Hemisphere, have been reasonably comfortable taking it directly. So there's actually been somewhat less interest in storage and floating storage and very old ships.
I wanted to get both of your comments on what's another sort of story of note that struck me. Sorry, I'm going to pull my mic up again. In Q1, particularly in CERAWeek, but also resonated before and after, and that is the IOC's sort of moving away from transition policies or narratives, or speaking out more aggressively against the transition. Christoph, your thoughts on that as a strategy? How that changes policy? Will we see more oil and more money in the ground for new oil capacity? Where do you think this rhetoric converts into policy and action and impact?
Well, first of all, I think the rhetoric is reflecting real concerns, and not just in the oil market. It has become increasingly clear that the simple story of substitutions, which we have been following since Kyoto in the 1990s, the problem is emissions, and therefore cut out fossil fuels, bring in clean fuels, and the problem is solved. That this story is too simple, because you cannot always substitute. It's too complicated, this market. Fossil part is too big, and you can show there are instances because of the intermittency problem in power generation where you just cannot substitute. So it's more a story of complementarities, which means you need to have everything and to combine it very intelligently. And of course, the IOCs and the tendencies that I was at CERAWeek, and so I jumped on that and pick it up. The whole industry says, yeah, okay, we still need ourselves. We don't need to only change. Everybody in the industry likes that narrative. And so we will see that this narrative is so becoming confirmed, because it's grounded in facts, that we will need oil, gas, and probably even coal in fast-growing economies for a long time to come, like it or not, if we don't want to crash their economies. And I think that what we will see in the parts of oil companies and gas companies in particular, if you refer to IOCs as those, then yes, there will be a slight pivot back, as we already see in the case of BP. And of course, the market all along has rewarded the Exxons and Chevrons and not the BPs and Shells. That trend will continue. Does that translate globally into higher or lower investment? This is a very doubtful about, because this crying wolf about investment gaps and not having enough investment in oil and gas. Since I'm in this industry, I hear this at every CERAWeek, and in particular from people who could do easily differently, from OPEC and the Middle Eastern guys. It would be a real problem. They would invest more, obviously, because they would make money on it. But it has never translated into a shortage, and it will not. So on the investment side, maybe less, but for the IOCs, it will be a welcome way to readjust a little bit backwards.
Mike, your thoughts on the same question, and also where it might intersect with, the likes of major trading hubs like Fujairah and others who have to consider about their, low carbon bunkers infrastructure and plans of the future and refinery compositions and so forth. Does this all add up to something new in your opinion, this new direction, or is it just more stating the facts of what was already in place? Your thoughts on these first quarter comments?
Yeah, it's a tough case of striking the right balance because the European majors, still being outperformed by the US majors, have appeared to pivot somewhat towards upstream and upstream gas in particular, and power being a more acceptable space to invest. But it would appear that traditional downstream oil is still pretty unloved, and there are some clear steps afoot from all the majors, the Americans included, to rationalize and essentially look to shed assets that are high carbon, high emission, and are never going to give them a fantastic return. There's more upside in exploring for deep water oil or for LNG scale natural gas than there is in building a storage facility or building or keeping refineries. So in that sense, I think you'll continue to see the majors very unlikely to enter into anything that gives them more refining exposure. On the contrary, it seems that that's something they're increasingly willing to exit. But I think the major refocus for the European majors, be it Mr. Sawan, Mr. Pouyanné, or Mr. Auchincloss, is upstream is okay. And the profits they're making that are beyond expectations a few years back are largely going there.
And of course, the strongest comments that were made at CERAWeek were indeed by the CEO of Aramco, who also made regarding the transition, I suppose, the comments that got all the headlines. And of course, Aramco made announcements early in the first quarter of abandoning plans to add oil production capacity. So it'll be interesting to see how all of this conversation plays out through the rest of the year in terms of oil, NOC and IOC strategies for CapEx investment. We'll have to leave it there. It's great to have you guys back at the table. OPEC Plus will only consider unwinding cuts if Brent moves above 100, generally 2-to-1 agreement in this room. We'll ask that question in a wider circle. Christoph, look forward to seeing you this week in Lausanne. Mike, are you coming to Lausanne, or will be seeing your colleagues?
No, there'll be plenty of my colleagues there. So if you're there,
absolutely.
give them my best. Thanks.
We'll look forward to seeing them. Mike Muller, thank you as always. I look forward to seeing you guys in May. Have a great month. All the best. Thank you.
Cheerio.
Bye-bye.